going to show you how tax returns work in your valuation enhancement, perks, how perks and benefits affect value, equipment purchase decisions, owner-occupied real estate, and also give you a few tax strategies that build your wealth. So the tax returns are the most credible document that we're looking at in evaluation. We look at the tax return, and it's the gospel truth. What a valuation does is it uses historical tax returns to establish the credibility of your future projections. But what we're valuing is future cash flow. We're not valuing historical cash flow. We're valuing what we think is going to happen in the business over the next, 3 to 5 years. So we take your tax returns and we establish what kind of trend is it. This is a nice stable trend. You know, some businesses very stable, some up and down. You know, here's a 5-year financial projection. You know, that's a trend that makes sense. This is a credible, you know, if I see this sort of a trend and then I see that's what you're telling me it's going to do, usually when I do evaluation, I just call you up and I say, what's going to happen the next 5 years in your business? Is it going to look like it did last year? Is it going to get better, worse? Is it going to be up 10%, down, whatever? You know, we run out, you know, a simple trend line that's credible, that's believable, that establishes what we think the earnings are going to be. So the tax returns are the most credible document in evaluation. They give us a story. They tell us a story. They give us a trend. So what story does your tax return tell? You can ask yourself that. How many years does your tax return have to tell a story before you go to sell your business? You know, 3 to 5. I'm going to ask for 3 years tax returns every time I do evaluation. The tax returns allow us to compare you to industry statistically. If you're, you know, most businesses are actually fairly statistically close if they're being run well. People don't really, you know, one business doesn't really dominate another one all that often in a big way. Most people are around the norm, statistical norm. So, you know, we're looking statistically to see, are you a little stronger, a little weaker than industry? If you're a little stronger, we expect your value to come up a little higher than the market, and so on. The financing from banks for your buyer is going to depend on your tax returns in a large way. If you're planning on getting cashed out in the business, SBA, you know, at the Main Street level, SBA is the best way to get the cash because most of the buyers don't have it. And so the financing from the banks is going to really depend on your tax returns and how they read. Yeah?
You say it depends on the tax return, but what specifically in the tax return? I mean, do I look at the overall tax return and say, well, your gross revenue has been reduced every year over the last 4 years, so on a go-forward basis, what does that translate to? Less value?
Not necessarily. It depends on the net income and the reasons why. I've seen businesses eliminate subcontractors and increase their bottom line substantially while their revenue went down, just by taking in-house some of the things that they were subbing out. So, you know, it really depends on the cash flow and what we expect the cash flow to do, and is it a, you know, how credible, you know, what does it make sense? I mean, really, a lot of this is just, was what you're telling me make sense or not? You know, I mean, is somebody going to believe it? You know, and that's really what we're looking for, is what makes sense and what doesn't make sense. Consistent, clean records reduce the perception of risk. You might be surprised to find out most valuation analysts are also certified in financial forensics. You know, all of our valuation analysts are also forensic accountants, and the reason is, I mean, you know, a good percentage of valuations are done for things, you know, where you got to kind of have a little forensic knowledge of what's going on in order to be able to identify problems. You know, anyway, the perception of risk. A good set of clean records will reduce the perception of risk. When I went and did that architectural firm, those guys, I mean, they paid themselves the statistical, they used the Architect Association survey of owners' wages to determine what their wage was. They had absolutely, I swear, no discretionary expenses of any. I had, like, to get to the cash flow, it's like I just added back the depreciation, subtract the capital expenditures. It was nothing. There was, their records were so clean and so consistent. I walked into their business, I sit down, and about their business was so structured. You could just look around. I mean, and people are creatures of habit. This is like the forensic mind. You're looking at the people to see what you're getting. When I see sloppy tax returns, I see risk. When I see, and I can read a tax return and I kind of know real fast, what's going on in there because I've been doing, tax returns for 20 years for small businesses, and I kind of, you see a lot of different variations. Yeah.
You've talked about the three different approaches to the evaluation,
Mm-hmm.
and you describe them as an either or. Is there a hybrid?
You can blend them.
For example, obviously there's an individual may be interested in my business from a cash flow standpoint. Another company in my industry might be more interested in my customer base.
Mm-hmm.
So then there's value there
Mm-hmm.
when you're talking about how much is to pay.
Sure. And every valuation done to USPAP will calculate an asset value and a market value and an income value and be included in the report. But they'll only rely on one value in terms of what the valuation analyst says they think the business is worth. And so you're going to see all of those. You're going to see calculations for all the different asset bases. And we'll get into when we start talking more about investment value a little bit later on. It'll answer a lot more of those sorts of questions because then we start looking at it from the buyer's side instead of the valuation analyst side. From a valuation analyst side, you can't assume that's who your buyer is going to be. You have to assume that your buyer is going to be this hypothetical, normal, average person walking the face of the earth, and that's who you're doing the valuation for, rather than a specific buyer, which I think is more applicable when in the circumstance you described. The red flags of risk, things that don't make sense. Abnormalities are going to be scrutinized. You look at cost of goods sold variance. People, I don't want to say manipulate their inventory, but people, adjust inventory. Well, the opposite goes to cost of goods. Well, you just run a trend on the cost of goods, and if it's doing funny things, and that's probably what's going on. Abnormalities will be scrutinized. Sloppy records and tax returns, those are red flags of risk. Smoothing income for tax purposes. People, putting, deposit checks in the drawer before right around year end and pushing them into next year or vice versa or what have you. All that stuff, they're easy to spot. Substantial discretionary add backs. I had a guy that had me do a valuation. He had a $100,000 bottom line. He gave me a list of $100,000 of add backs. Discretionary. It's like, okay, wow. So what you really want me to do is you want me to use a cash flow of $200,000 to value your business. And what you're saying is that you've got $100,000 of things that you're writing off that are legitimate tax deductions that aren't necessary for the ordinary operation of your business. And so you want me to add those back for the cash flow purpose. We audited, we went through that with a fine-tooth comb. We traced every stinking one of them back to his books, and it was right. I could not believe it. It's the only, but I'm telling you, if there's anything that looked ugly, it's something like that, and it draws a ton of attention. Unrealistic projections, hey, I've been doing 200,000 a year, but next year I'm going to do 8. And from there on out I will. Therefore, my business should be valued based on that. Most of the time, if it's too good to be true, it probably isn't true. I mean, Madoff, I put that on there. I mean, it just is. And that definitely is the forensic mind. It's like risk and return. They got to match. I mean, otherwise there's something wrong with it. I've got a client that's kind of running around bragging right now about what a great deal he's making on this real estate. He's buying a $2.8 million property for $800,000, and I'm thinking to myself, something wrong here. There's either undisclosed risk, or this is a gift, or something, because there's somebody involved. It's a disguised transfer of an asset, or it doesn't make sense. I'm hunting for it. There's something going on in there that isn't right. It smells bad. Risk and rate of return, they go hand in hand. There's something risky in that deal. If he's getting that good a deal, there's something wrong with it. There's got to be. I'd be looking that one over really hard. I do purchase valuations for buyers. Buyers thinking about buying a business, they come in to get a valuation on it. If I see a lot of this stuff, I'm like, don't touch it. It's bad. Something's wrong. If the books aren't clean, don't touch it. You just don't want it. It's going to come at you somewhere. A good set of clean records, it reduces the perception of risk. All of those other items increase perception of risk. So cash flow times multiple equals value. That's our rule. So how are perks and benefits valued? You know, will the following add value to the business? Use of company car, shareholder meetings in Hawaii, fancy titles, pride of ownership. If it doesn't improve your cash flow, it doesn't improve your value. Unless it's, you know, I don't know. I mean, I don't know how it does. Unsophisticated buyer will see value in the perks. I mean, I see it all the time. I'm not saying it doesn't happen. I'm just saying it shouldn't add value. Theoretically, it shouldn't add value. But, you know, like 10 or 15 years ago, we had a guy that sold his house in Seattle, got a big pile of cash, came over here and bought a business. The business didn't cash flow anything. And 5 years later, he was broke. What did he do? He worked for free for 5 years. But this is what he saw: pride of ownership, fancy titles, all that stuff. He paid $200,000, I think it was, for the business. It wasn't a real big one, but he just went broke in 5 years. So an unsophisticated buyer will see that. Nuts and bolts, you know, no value added. Theoretically, no value added. Cash flow is the key. If it reduces your cash flow, it reduces your value. If it improves your cash flow, it improves your value. Pretty simple to equipment purchase decisions are no different. Okay, I had a person attend my presentation and they had just upgraded all their delivery vans. I felt bad, but they said that it wasn't going to change anything in terms of their cash flow. You know, the old vans were just a little bit of a nuisance sometimes to run. They were a little bit more maintenance and they weren't quite as nice looking, but they really weren't going to improve their cash flow. So how did adding or upgrading that equipment, if it sustains your cash flow, that's an expense. If it improves your cash flow, that's an investment. So if you have to replace the delivery vans, capital expenditure, to maintain the value of your business, that's an expense. But if you can invest in new delivery vans and they go twice as fast and deliver twice as much stuff, and now you got more cash flow, then that's an investment. And it should improve your value. And same deal with modernizing equipment. And then let's talk about facility. One of the #1 tax strategies that I promote, I think the natural evolution of business owner wealth development is start a business, you buy owner-occupied real estate, and then you invest in stock market. Owner-occupied real estate is outstanding way to build your wealth. Small business value is about, if you have cash flow in a small business, it's worth about 3 to 5 times a year's earnings. So if you have $100,000 of cash flow in your business, it's worth $300,000 to $500,000. That's what that business is worth. But if you can, by owner-occupied real estate, establish a lease, real estate sells for about 12 times cash flow. Same sort of concept. So the strategy is to pay the maximum market rent that you can to your owner-occupied real estate and then sell your business with the lease in place. So you've converted some of your business cash flows to lease cash flows that are worth 12 times rather than 3 times. The other benefit here is that you can cost segregate owner-occupied real estate at purchase and get about 20 to 40% usually of that value assigned to personal property. And you can assign that to personal property. So carpet is personal property. You buy it with the building, you pay one price for the building, but what's the value of the carpet? So we separate that. That's personal property. Now you can Section 179 that. You can get some huge tax deductions out of the acquisition of real estate without really losing any wealth. How did you lose any wealth? It's not like a computer that just becomes worth a lot less the minute you buy it. Real estate goes up in value. So you're getting great tax deduction. Theoretically, you know, an improvement in your wealth, a way to convert some of your cash flows into the cash flow that's more valuable. To me, with the exception of maybe this is last real estate kaboom, but you know, I think of real estate as a long-term asset. If you don't have 10 years, don't buy it. If you're not going to be in it at least 10 years, don't touch it. Okay, but it's an inflation-adjusted, appreciating perpetuity with tax benefits. It just doesn't get any better with that. It's one of the best sources of business owner wealth development right there.